Right. Good morning. I think this is for Kandy students on Diploma in Credit Management, and up to now we have completed with this previous one lecture. Up to now, you have been given about the up to now. I will briefly explain what is done up to now. Actually, we have got a basic understanding about the financial accounting before when it comes to these financial statements analysis. We spent about a half day on the basic understanding about the financial accounting, and the second part of that first day session spent on the evaluation of this credit management of a client in a banking organization. Thereafter, we went through the financial statement analytical techniques that we use to analyze the financial statements of a potential client uh, using various techniques. Under that, we did three evaluations mainly. First one is the vertical analysis, then the horizontal analysis, then finally the ratio analysis. As far as your examination is concerned, uh, you need to know a thorough knowledge on the third topic, that is the ratio analysis. Uh, I think you have already got to know about the relevant ratios that are being applied for the financial statement analysis uh, in terms of analyzing a customer's credit worthiness. Uh, uh, Now today we are going to do basically two sums relating to those ratio analysis techniques. And I'll start from the first question, that is November 2016 examination, question number one. Uh, as far as your examination is concerned, the format and the structure of the question is very much similar to this question. Uh, Now, if you read out the question properly, uh, what is given in the 2016 November paper, I will read out it first. You are the credit officer of Royal Bank PLC. MS Fashion Apparel Private Limited is one of the leading exporters of ready-made garments with a brand name Butterfly, and a prime customer of your bank, and maintain satisfactory conduct current account at your bank. At present, they also enjoys the following credit facilities, right? You have to make a note of it, that they have applied two credit facilities, that is term loan and overdraft. A current approved limit for term loan and overdraft is 8 million and 10 million each. But if you take the current outstanding, it's 58 million and 16 million. Now, make a note of it that even though the limit of overdraft is 10 million, now they have exceeded up to 16 million. There is a sanction limit breaching currently. You have to ensure that you are being addressed this breaching of over 6 million over the current limit of 10 million. The term loan and overdraft facilities are secured by the mortgage of 90 million on freehold property owned by the company, housing the office complex, and factory valued at 150 million. Now, their factory valuation is 150 million. Now, bank has given 90 million facilities altogether. That means if you take into account the security value and the amount of exposure that the bank has given, it's about 60%. 90 divided by 150 into 100, that is 60%. Therefore, the bank currently has an exposure of 60% of the property. Right. That is also, you have to make a note of it. These facilities were granted 2 years back, and the term loan was for a period of 5 years. Right. Because of the high quality of the products, MS Fashion Apparel Limited, there is an increased demand for the brand name product Butterfly. In order to meet this requirement, the company has to purchase additional machinery at an estimated cost of 10 million and needs additional working capital of 5 million. Right? There's a requirement of 10 million and 5 million each. Right? The Chief Financial Officer, MS Fashion Apparel Private Limited, had approached your bank for additional facilities to meet requirement. You as a credit officer had requested for the income statement and financial position statement of the company for the financial years 31/3/2014, 31/3/2015, and 31/3/2016. And they have also given the summarized financial statements, and you can see the format starting from turnover up to retained profit, the income statement, and on the other side of the question paper, that is the statement of financial position. You have assets, current assets, non-current assets, and equity, capital, non-current liability, current liabilities for the 3 years ended. And in addition to that, they have also given the balances in balances that was there as at 31/3/2013. I think that is for a purpose, right? When it's come to ratio calculations, when you have to compare it with the previous year, if you want to take the averages, I think you know for sure that there is a the point that we have emphasized when it comes to a ratio which is calculated using two figures of one figure from income statement, one figure from statement of financial position. The figure from the statement of financial position needs to be an average one, right? That is a must, right? Right. In order to calculate averages, they have also given the figures as at 31/3/2013. And in addition to that, you may use average balances for the computation ratios whenever necessary. 90%, the third point is 90% of the sales are on credit basis, 10% on the cash basis. That is also a point to remember. The company stated capital 112 million from the inception, consisting of 8 million ordinary shares. A recent valuation of the property indicated a value of 170 million. The original value is 150 million. Now they have got a recent valuation report that says its value is 170 million. Resulting, you can have more exposure that at the current level, 60% exposure is there. 150 into 60%, that is 90 million worth of facilities have already been disbursed. Now they have got a new valuation report that is 170 million, meaning you are left with additional 20 million and on account of that 60%, 20 million into 60%, that is 12 million additional exposure you can accommodate. And the requirements are more or less similar to the same things. Right. Can you all hear me? Use please you unmute your mics and please give a feedback. Right. Okay. Three requirements are there. First, you have to calculate, and the first question, you have to calculate the ratios and you have to do a risk analysis. For ratios, calculation of ratios, 15 marks allocated. For risk analysis, 5 marks allocated. And so question number 2, in the event of considering additional facilities, describe the type of facility you may recommend, right? And question number 3, suggest your recommendation to the management of MS Fashion Apparel Private Limited to enhance the financial position without requesting additional facilities from the bank. Right. We will start calculating the ratios as per the first requirement. Make sure that the point I emphasized earlier, that is when it comes to a ratio which is being calculated using one figure from the income statement and one figure from the statement of financial statement, financial position statement. The figure from the statement of financial position needs to be an average one, right? You have given all the figures for you to calculate the averages, right? There is no requirement to calculate specific ratios, but you know that we have described and learned about mainly 6 categories of ratios, starting from profitability, asset efficiency, liquidity, gearing, and working capital and investor relation ratios, right? Under each heading, you have to calculate the ratios, at least 15 ratios, right? Meaning every category, at least you may have to prepare 3 ratios each, right? I will start from the profitability ratios. Under profitability ratios, the main ratio is the gross profit ratio. Now, you have been given 2014, 15, and 16 financial statement. Therefore, you can calculate the gross profit ratio. You know the ratio. Gross profit equals gross profit divided by sales into 100. Very simple. Gross profit divided by sales into 100. Now here you have to clearly understand, because when I mark the previous batch papers, answer sheets, I found in several locations people incorrectly taken the, instead of gross profit, they may have taken the net profit. Therefore, very clearly, when it comes to gross profit ratio, you have to take the gross profit and divided it by 100, divided by sales into 100. Now here, no need to take averages, since both items in the ratio are from the income statement. In that case, you need not to take the averages of the items. Now, if you go to the financial, the question and the financial statement, income statement, you can see under gross profit, in each year 14, 15, and 16, the gross profits are given, that is 161,000 and 181,000, 108,000, 208,000. And sales figure also given. Sales can be reported maybe differently reported as turnover or income, right? But whatever name you use, it means sales. That is also given in the first line item. That is 350,000, 420,000, 510,000, respectively for each of years. Right. Now, simple calculation, gross profit divided by sales into 100, and you will be end up with 46%, 43%, and 41% gross profit ratio. Right. Gross profit ratio. Right. First, we will calculate all the ratios. Then, after that, we will summarize the ratios and make interpretations on this. Right. Now, very easy to calculate and understand the GP ratio, gross profit divided by sales. No need to take averages, since all figures are from the same income statement. Then the net profit ratio, similar to the gross profit ratio, net profit divided by sales into 100. There are also no need to take the averages, as two figures or two items are from the same statement, that is income statement. For 3 years, 2014, 15, and 16, net profit, you have 39,400, 44,800, 51,200. Under sales, 350,000, 420,000, 510,000, right? Therefore, ratio is net profit divided by sales into 100. The answer will be 11.26, 10.67, 10%, right? We will finally make the interpretation at the latter stage. after we calculate all the ratios, the point here is I am emphasizing repeatedly, no need to take any averages as both figures or both items are from the same state, right? Therefore, in that case, you need not to take any uh, average figures as far as these ratios are concerned. But in case of ratio, if you take one item from the income statement, another item from the statement of financial position, the item you take from the statement of financial position needs to be an average figure, right? That is a must, right? Now, the net profit ratios are therefore 2014 11.26, 10.67, and almost 10% in 2016. Then the third ratio under profitability, that is return on equity. Return on equity. This is also one of the main ratios under profitability. How you calculate, that is net profit after tax. Net profit after tax divided it by average equity into 100. Divided it by average equity into 100. Why we take the average equity? That is one item, that is the first item, net profit after tax is from the income statement. But the second item in the ratio, that is equity capital, that is from the statement of financial position. Therefore, the item from the statement of financial position needs to be an average figure, right? Now, when you take average figure, it will reduces the asset date positions of individual items in the financial statements, right? For example, say you have a competition. Why we take average figure? Now I'm going to explain that, right? For example, say you have a competition and you have two customers. One customer, he deposited at the beginning of month, he deposited 100,000, and till the end of the month he had this 100,000, right? Therefore, his average balance for the month is 100,000, right? But there is a second customer, he deposited 150,000 at the end of the month. That is, say January month, say 31st January. Therefore, at the end of the month, his balance is 150,000. But if you take the average as an average figure for the 30 days in 31st days in the January month, his average will be less than 150,000, very less than 150,000, because he deposited the money at the end of the month, that is 31st January. But the other customer, he had deposited the 100,000 at the beginning of the month, but he uh, keep the 100,000 same throughout the month. Therefore, his average balance is 100,000. But if you take, now I said there is a competition, right? When it comes to this competition, if you take the asset balance, right, you tend to take the 150,000 because his balance is higher than the 100,000. But as far as the bank is concerned, the average balance is more in case of first customer, as he kept throughout the month the 100,000. But in case of the 150,000 customer, his average balance is pretty much low. Take the average balances, first 30 days he has zero balance, but at the last date he had this 150,000. Therefore, if you take as an average, it will be very low. Therefore, I am emphasizing why we take these average balances, right? When you're taking average balances, there can be, you can easily reduce or you can easily avoid this asset day if there is a exceptional situations, right? Therefore, that's why if there is a ratio, when it's come to this statement of financial position, right? Now you see it is a asset day balance, right? To take the statement of financial position, it is a snapshot of a given day, right? To take a picture, right? Assuming that you take a picture as at 31st December, that is the position as at that date, right? After that date and before that date, the position is too different, right? Therefore, uh, we prepare statement of financial position for a particular date, right? Now in that date, particular balance is there, that is for that day only. Before that date may not be there, after that that balance also may not be there. Therefore, to avoid these exceptional situation, as at a particular date, we tend to taking average balances for the statement that we prepare and publish for a date. That's why I asked you to, when it's come to a ratio calculated based on these two figures, that is one from the income statement, one from the statement of financial position, you have to take the average figure for a item that you are using in the from the statement of financial position. That's why we, under return on equity, we took one item, that is net profit after tax from the income statement, divided it by equity capital. For equity capital, you need to take the average balance into 100. Right. Now we are going to calculate. Now, if you take the net profit after tax, it is given to 14, 15, and 16, 39, 400, 44, 800, 51, 200. Now we need to take the average equity balance. Now, if you go to the statement of financial position, now beginning of the year, that is for 2014, beginning balance or beginning equity is, I have given 92,000. Have you arrived at this 92,000? If you go to the note, they have given under note number 1, the balances as at 31/3/2013. That is 2014 beginning balance, right? To take a financial year 2014 31/3 means the starting point of 2014 31/3 is the 2013 April 1st or 2013 31st March, right? Now they have given this balance. Now, to take the equity comprises of two parts mainly. That is stated capital plus reserves. Now you have to go to this note number 1 and find out what is the stated capital and what is the reserves, right? If you go to the note number 1, it's clearly given. The retained earning is 20,000 loss, right? 20,000 loss retained earning. That is, you have a reserve, but it is a negative reserve. You have a loss. And the stated capital under first note, fourth point, the company stated capital 112 million from the inception, right? Therefore, what you do is you have to add this 112 million plus that negative 20,000. That's how you arrived at this 92,000, right? This 92,000 we calculated after adding 112,000 plus negative 20,000. That's why we have a 92,000 positive balance. If it is a positive reserve, you have to add back. But in case of this company, at the beginning of 2014 or at the end of 2013, they had a negative reserve, that is 20,000. Therefore, you add stated capital plus reserves. Stated capital is 112,000, but reserves are negative 20,000. Therefore, altogether 92,000. Then, at the end of the equity in 2014, you have to go to the financial statements. In financial statements, under balance sheet or the statement of financial position, under capital and reserves, right? You have a total of 115,400. 115,400, which comprise of 112,000 stated capital plus now they have got a 3,400 retained profit. That is a positive one. Therefore, altogether 115,400. Now you can take the average figure. Beginning of the equity 92,000, ending equity 115,400. Therefore, average figure is 103,700. Likewise, now If you go to the 2015, the beginning equity will be the ending equity of 2014, right? Beginning equity of 2015 will be the ending equity of 2014. Therefore, you can easily fill that part. Beginning of equity 2015, 115, 400. Now, how you calculate the ending equity of 2015? That is, if you go to the balance sheet, again, capital and reserves, the subtotal is 128,200, right? 128,200, which comprise of 112 million of stated capital plus retained earning of 16 million to 1. 16 million to 1, right? The similarly, in 2016, the beginning equity will be the ending equity of 2015, that is 128 to 100. The ending equity of 2016 is 139 400, which can be extracted from the balance sheet, right? Then thereafter, you can calculate the average figures of 2014, 15, and 16, which is 103 700, 121 800, and 133 800. Now you can calculate the ratio, right? By calculating the ratio, the answer will be 37% and 36.78, 38.27. Right. We will interpret all these ratios at the end of after we calculate all the ratios, right? That is return on equity. Now, the important point on the return in equity, we took the average figure for equity capital, since the two items are from the two statements. That is very important. Right. The next ratio under profitability, that is return on capital employed. Return on capital employed. This is also a very important ratio. Now here we take the total capital. We take the total capital, right? At the first ratio, the one before the this ratio, we took the equity capital only. Now here, return on capital employed. Capital employed comprise of two capital mainly, that is debt capital and the equity capital. Now in this ratio, we have to accommodate the debt capital as well. Now in this ratio, you can see you have to take the average figures for the balance sheet item. That is statement of financial position item. That is capital, equity capital and debt capital. We have to take the average figures. And the net profit before tax you have to take. It is given in the income statement very clearly. Now make sure, now when I correcting the papers, I can easily come across at least 10 people that they have taken erroneous figures from the income statement, even though it is very straightforward and given in the question paper itself. Now here you have to take the net profit before tax. Now in that case, you have in the answer sheet, you have clearly, I can see, you can clearly write the net profit before tax, but when it's come to taking of the particular figure, you took the net profit after tax. Therefore, make sure that you take the correct figures, right? Net profit before tax, we add interest also. We add interest because we are taking the debt capital, right? Since we are taking the debt capital, we have to add interest also. Then thereafter, you can calculate the net profit before tax and interest. Now, everything is given in the income statement. You can directly take the figures from the profit before tax and the interest from the income statement. Now, you can derive at net profit before tax 69,000, 73,000, 81,000. Right. Now, in the previous ratio, you have already calculated the average equity. You have already calculated the average equity. Therefore, you can easily take that figure. 103,700, 121, 800, 133, 800. Now, you have to take the average long-term debt. Now, go to the balance sheet. Now, if you go to the balance sheet, the long-term debt under non-current liabilities is the term loan. Now, how you calculate the average for 2014? End of balance is 80,000. Beginning balance, you have to go to the note number 1. they say term loan 50,000. Therefore, when you are to calculate the average, 80,000 end in 2014, beginning 50,000, altogether 80 plus 50, 130,000, divided it by 2, 65,000, right? 65,000. That is how you calculate 2014 average long term debt. I will repeat it again. 2014 ending loan balance is the long term debt, that is 80,000. Now, for you to calculate 2014 average balance, you need the 2013 balance as well. Now, go to the note number 1. It is there, term loan at the beginning of 2014 or at the end of 13, 50,000 is there. You have to add 50,000 plus this 80,000 is in the balance sheet, altogether 130,000. Then divided it by 2, that is 65,000. Similarly, you can calculate the average long-term debt capital in 2015. I will explain. Now the answer is 74,000. How you get an answer of 74,000? You take beginning of 2015, that is ending of 2014, the long-term balance is, loan balance is 80,000. And ending of 2015, the balance has reduced to 68,000. Therefore, altogether 80,000 plus 68,000, altogether 148,000. 148,000 divided it by 2, that is 74,000. 74,000. Then 2016 average figure, again you have to take 2015 end balance, that is 68,000. You add 16 in balance, that is 58,000. That is 144,000. 68 plus 58, right? 68 plus 58, then that is 146,000. Divided it by 2. Divided it by 2. That is 63,000, right? 63,000. Then the average capital, to altogether the average equity plus the average debt, term debt, that is 168,700, 195,800, 196,800, right? Then you calculate the ratio. You have to divided the net profit before tax and interest. For 2014, that is 69,000, divided it by average capital employed, 168,700. Then the answer will be around 37. Then under 2015, it will be net profit before tax and interest is 73,000, divided it by 195,800. The answer will be 37%. In 16, it will be 41%, right? We have already distributed even for the Kandy students. We have already distributed these answer sheet. You can have you need not to write anything. You have to get the understanding about how we calculate and the important points that we have to remember. Here the important point is when it comes to return on capital employed, you take the net profit before tax and interest. Right, before tax and interest, because we are taking under return on capital employed both the equity capital plus long-term debts. Therefore, for the long-term debts we are paying interest. That's why we add back the interest part also. What is the return we earn, right? What is the return we earn for both equity holders and long-term debt holders? That's why we add back the both the return net profit before tax plus the interest. Right? That is the return we earn for equity holders and debt holders, and into 100. Right. We will summarize all these findings into one sheet and interpret at a later stage of the presentation. Right. Then another ratio under profitability, that is return on assets. Return on assets. Now, when it comes to return on asset, it can be computed either net profit after tax or net profit before tax. But you have to mention whether it is net profit after tax or before tax. But in most of the cases, people tend to calculate this ratio, net profit after tax. Now, here also one item from the income statement and the second item from the balance sheet or the statement of financial position. Therefore, you need to take the item from the balance sheet or the statement of financial position as an average figure. That's why we took average assets, right? The ratio is net profit after tax divided it by average assets into 100, right? Now, very straightforward, net profit after tax, it's given in the income statement, 39,400, 44,800, 51,200. Now, you need to take the average balance of the assets. Therefore, 14, the beginning total assets, it's given in the note number 1, total asset, 180,700, 180,700. Then under ending assets, it's given in balance sheet, 2014, the total asset figure is 228,500. 228,500. Therefore, the average figure is 204,600. 204,600. Similarly, you can calculate the average asset figure for 2015 and 2016, right? 2015 and 16. The figures will be the final figures for ROA, return on assets, will be, you have to divide the net profit after tax by average assets into 100. The answers will be 19.26, 19.08, 20.7. Now, very important thing as far as bankers are concerned. Now, if you go to your bank financial statements and compute this ratio, normally banks publish this return on asset ratio. It will be a very small figure, right? Compared to, now if you take this example, it's around 19-20%, right? But if you go to a bank, every bank, the top banks, now they may not exceed this ROA after tax, right? At least 2%. At least 2%. If it is 2%, that is a very good bank. Now, my question is, why banks do have these small ROA percentages? Comparative to the other business organizations, the banks do have very small ROA percentages. Now, in most cases, it will be 1% to 2%. Why? Now, because even though bank have a material profit, but when it comes to their assets, the profit is very low. Why? We do have, as bankers, we do have huge balance sheets. Now, if you take a small size bank, they also have more than 350 billion assets. 350 billion assets. To take top rank companies like JK, SLT, Dialog, you name the biggest companies in Sri Lanka, they may not have that much of size of total assets. They may, maximum they may have 350 or 400 billion assets. But if you take a small size bank, they have more than 300, 400 billion worth of assets. But when it's come to the top banks, they have more than 1 trillion asset base. The public banks and the private banks, all top 3 public and private banks, they may have more than 1 trillion total asset base. Why bank do have these total assets pretty much higher than the other normal business organizations? Because we do have something called deposits, right? Our total assets, if you take a bank, bank's main asset is the loans and advances. Now, if you take the total assets of the banks, it is financed more than 90% of using these deposits. The actual owners or the shareholders contribution, it will be less than 10%. Therefore, in a bank, the total assets is normally more than 90% is financed by deposit holders' money. Therefore, our balance sheets are huge. Banks do get huge funds from deposit holders. That's why our balance sheets are huge. That's why we have now actually banks are dealing with public money. That's why we have so-called a central bank, right? Very much a regulatory body, and we have special rules and special ratios like liquidity ratios, capital adequacy ratios. If you take the ratio list goes on, we are a different organization to a normal business organization. We are dealing with public money. That's why our balance sheet size is higher and our assets is also higher, resulting a lower return on assets, right? That is a point to remember. But in case of the business organization, in case of yours, the companies you are evaluating, the standard should be ROA. It should be at least 90-20%, right? 19 or 20%. Then this is also under profitability. This is very important ratio, that is interest cover times. Interest cover times. How do you calculate this ratio? Right. Now it's given interest cover equals net profit before tax. Right. You have to take the net profit before tax plus the interest and take the total, divided it by interest. First you take the net profit before tax, then add interest, take the total and divided it by interest. This ratio is computed as number of times. Number of times. Right. Now I will spend a little more time on this interpreting this ratio. We will interpret again, but maybe I think very appropriate interpret here at this point. Now, how do you calculate? You have the formula, you calculate. How do you interpret this ratio? Now, if you take 2014, 15, 16, net profit before tax 56,400, now it's given. And you add back the interest each year, and no need to take averages since both figures are from the income statement. And you arrive at a figure called net profit before tax plus interest and divided it by again using the same interest that you add back. And you can have a figures like 5.48, 4.51, 3.81, right? Right. Now, how do you interpret? Now, what is this ratio meant to the bankers? Now, this ratios explain the number of times an entity can pay the interest using their profits. Number of times an entity can pay the interest portion using their profit. If the number of times is higher, the better it is. If the number of times is less, it is not good, right? Therefore, if you take 2014, it is 5 times. That means using their profit, the company can pay 5 times of the interest. But in case of 2016, it's almost 4, meaning now they can pay only 4 times using their profit, the interest portion. The higher the number of times, better it is. I think you can easily get the understanding, right? Now that is profitability ratio. We have discussed under profitability ratio, gross profit, net profit, return on equity, return on capital employed, return on assets, and interest cover. 6 ratios, right? But in case of your exam, you need not to compute and interpret more than 3 ratios. Now, if it is 15 ratio, you have to divide it by 6 categories, and every category you have to explain about 2 ratios or 3 ratios, right? Then the second category is the liquidity ratio, right? Liquidity ratio. Under liquidity ratio, we have 2 main ratios, the current ratio and quick asset ratio. Very easy to calculate, but here also the point to remember, if you are taking one figure from the income statement and another figure from the statement of financial position, you have to take the figure from the statement of financial position as an average figure, right? Right, current ratio, very straightforward. You have to take the current assets and compare it with the current liabilities. Now, in this ratio, how do you calculate and how do you interpret? If the current liabilities is 1, what is your current asset position? If the current liabilities is 1, what is your current asset position? Right? Now here, current liability, if you take, go to the example, 2014, 15, 16, if you put the figures, current assets 51,500, current liability 33,100. Meaning, for one current liability, you have 1.56 current assets. For one current liability, you have 1.56 current assets. For 2015, same ratio, for one current liability, you have 1.52 current assets. 2016, the same ratio is there. For one current liability, you have 1.54 current assets, right? This is what is meant by liquidity, right? Especially in a shorter period of time, if the company wants to repay their creditors or short-term borrowings, the companies should be in a position to repay those things by having a healthy current asset positions, right? If you take the assets, they can be categorized into two, that is current assets and non-current assets. Now, these current assets can be easily turned into cash without incurring any material losses. But when it comes to these non-current assets, it cannot be immediately converted into cash. It will take time, but you can immediately convert it to cash, but there will be a loss, right? Under normal market condition, if you want to convert immediately, there will be a loss. Therefore, as far as liquidity is concerned, the word liquidity says if any asset is can easily be converted into cash without incurring losses, that is a higher liquid asset. But if it is take time, that is a lower liquid asset. Therefore, normally non-current assets are very low liquid assets, but the current assets are very high liquid assets. You know, under current assets, the items you can remember, main item is the cash, stocks, or the inventory and debtors, right? Now, in this ratio, all the current assets, compare it with the current liabilities, and you can find out the liquidity ratio as current ratio. We will do our interpretation part at the later stage. Then the second ratio under liquidity, that is quick asset ratio. If you take out the inventories from the current asset, you can arrive at the quick assets. Why we take out the inventory? Even though we say inventory is a current asset, it is also taking some time to convert into cash, right? Inventory also will take some time, not immediately, right? Even though it will be a shorter period, but it will be some period compared to debtors and cash. Cash you need not to convert because cash is cash, no? Therefore, but when it comes to debtors, debtors you can easily convert into cash by asking them to pay, right? But when it comes to inventory, there should be some customers to take off those inventories. Therefore, it will take some time. Therefore, under liquidity, we compare a different ratio that is called quick asset ratio by excluding inventories from the current assets. Then we can call that amount as quick asset, compare it with the current liabilities and calculate the ratio. Now, if you compare with the current liabilities, the quick asset you have, now in 2014 you had current assets of 51,500, inventory 18,500, then your quick assets will be 33,000. and compare it with the current asset in that year, 33 100, that is how much your quick asset compared to current asset. One, how what is the uh, quick asset position compared to the current liabilities? That is one. In 2015 also the similarly you can calculate, that is 1 is to 0.98, that is almost 1. In 2015 also 1 is to 0.95, that is also approximately 1 is to 1 ratio, meaning this organization has, for one current liability they have one quick asset, right? For one current liability they have one quick asset, right? Those are the two main ratios under liquidity. Then we can go to the uh, uh, working capital ratios. Working capital ratios. Under working capital ratios, first we will, what are working capitals. Working capital mainly includes inventory, debtors, and creditors. Now first we take on the inventory ratios related to working capital. First ratio is inventory turnover ratio, right? Now this inventory turnover ratio can be computed in two ways, that is as a ratio of number of times and as a ratio of number of days. For better understanding, you may always take the second ratio category, that is inventory turnover ratio in terms of days. That will be easy to interpret and easy to understand also. But anyway, I will explain the two categories, but I prefer the second category you have been used when it comes to this examination, right? If you take the inventory turnover ratio as number of times, you have to take the cost of sales divided it by average inventory. Cost of sales divided by average inventory. Why we take the average inventory? Cost of sale is a income statement item, but inventory is a statement of financial position item. Therefore, in that case, you have to take the average balance of the item you took from the balance sheet, right? If you take the 2014 cost of sales is given, very straightforward. You can go to the income statement directly. You can take those figures: 189,000 2014, 240,000 in 2015, 302,000 in 2016. Uh, when it comes to calculating the average inventory figures, beginning of the year 2014, that is end of 2013, the inventory figure is given in note number 1. In additional note, 15,500. The ending inventory is given in the balance sheet itself or the statement of financial position itself. Under current assets, you can see 18,500. 18,500. Similarly, you can repeat the ending inventory of 2014 will be the 15 beginning inventory, 1815, and straight away go to the 15 balance sheet and take the ending inventory of 2015, that is 24,000, and that 24,000 will be the beginning inventory of 2016, right? And ending inventory of 2016, go to the balance sheet, and under current asset there is a figure called inventory under 2016, 32,000, and then you have to add back those two figures and calculate the average figures for each year. For 2014 it will be 17,000, 15 21 25 250, and 16 28,000. Now you can calculate the ratio, that is cost of sales divided it by average inventory. Cost of sales divided it by average inventory. It will be number of times, that is 11, 11, and almost 11 in 2016. Right. This means the inventory turnover ratio means Now, if you take this first 2014, the number of time is 11. That means your inventory being 11 times converted into sales. All of your inventory being converted into 11 times during a year into sales, right? The higher the number of times, the better it is, right? You can turn over your inventory higher the number of times, then better it is. Now, if you go to the next ratio, that is the same ratio in terms of days. This is what I recommend for you to calculate in the exam. This ratio is the other way around, that is average inventory divided it by cost of sales into 365. Average inventory divided it by cost of sales into 365. Now, if you take this ratio, very straightforward, the same balances you can take, cost of sales and average inventory. The difference is this time the average inventory divided by cost of sales into 365, right? Then you can arrive at figures as days 32, 40, 34, right? How do you interpret that? Meaning if you take 2015, the answer is 32 days, right? How do you interpret this 32 days? This means your inventories are 32 days means 1 month, no? Right? Your inventories are stays as inventories, not being converted into sales for a 1 month period, right? Normally, this company's inventories stays for 1 month, not being converted into sales, right? Now, if I similar thing, if I repeat it again, normally these companies inventories will remain as 1 month, not being converted into sales, right? Now you can, if you go to the previous slide, in 2015, that is 11.29 times, that is almost 12 times, meaning 12 times I mentioned 12 times your inventory is being converted into sales in a given year, right? If you want to convert your inventories in 12 times in a given year, meaning every month you have to convert. The same answer is, you can arrive at the next ratio, that is inventory turnover period, that is 32 days, that is 1 month period, right? But better understanding, easy to calculate, can be more accommodated in this inventory turnover period than the inventory turnover ratio, right? People get stuck in interpretations as far as the inventory turnover ratio is concerned, but inventory turnover period, since it is given in days, you can easily interpret, right? Therefore, I would recommend for you to calculate this ratio instead of calculating inventory turnover ratio as number of times, right? Then next ratio under working capital, that is debtors collection period. Debtors collection period. How do you calculate? How do you calculate? You have to take the average debtors, divided it by credit sales into 365. The simple meaning of this ratio is what time your debtors are taking to repay your debts, right? You know, when it's come to credit sale, you will end up with debtors, and you will be given, sorry, debtors will be given an additional period to repay. Sometimes it may be 2 weeks, 1 month, 2 months, or 3 months. Now this ratio calculate the number of days that the company given their debtors to repay. If it is higher, that is not good, because if the debtors are taking too much time to repay, that means the company finance debtors, right? Therefore, by taking debtors money early as possible will be beneficial for the particular company. Then once you collect that cash flow, you can invest those cash flows or to repay one of your liabilities or to invest in a different project. Right? How do you calculate debtors collection period? You have to take the average debtors, divided it by credit sale into 365. Right? If you go to the sum, they said the credit sales are 90% of the sales. Therefore, you have to directly go to the income statement. You have to see what is the turnover and take 90% of that turnover. Now, if you go to the 2014, the sales figure is 350,000. 350,000. Take the 90% of that. Take the 90%. 90% is 315,000. Similarly, in 2015, 420,000, take 90%, 378,000. Go to 2016, 510,000, take 90%, 459,000. Then you have to calculate the average debtors, right? Beginning of the debtors 2014, that is end of 2013, it's given under note number 1, debtors balance, trade receivable 25,000. Trade receivable means debtors 25,000. 2014 beginning balance is the 13 in balance, that is 25,000. Now go to the balance sheet. Under current assets, there is a figure called trade receivables 27,000, that is 2014 end balance. Right. Similarly, the end balance of the debtors 27,000 will be the beginning balance of the 2015, and you have to take from the balance sheet, that is 36,000 end balance of 2015. This 36,000 will be the beginning balance of 2016, and you have to take the ending figure of debtor balance 42,000 from the balance sheet. Now you can take the average by adding those two, end balance and beginning balance, and divided it by 2. Then you are end up with average debtor balances of 26,000, 31,500, 39,000. Now you can calculate the ratio, that is debtors collection period equals average debtors divided by credit sales into 365. That is 30 days, 30 days and 31 days. We will finally make the interpretation, right? Then creditors payment period. Creditors payment period. If you take the creditors payment period, similarly, you have to use the formula given. The formula is average creditors divided by purchases into 365. Average creditors divided it by purchases into 365. Right. Now, you may have a problem of finding the purchases figure. You may have a problem of finding the figure of purchases. Now, it is not given directly, but you know how to calculate purchases from the given balances. Now, if you go to the trading account of an entity, normally you calculate the cost of sales by adding beginning inventory plus purchases, deduct closing inventory, and you are arriving at a figure called cost of sales, right? But in the example, in the sum, the purchase figure is not given, but you are being given the cost of sales figure, beginning inventory and ending inventory, and now you can calculate the purchases. Now, how do you calculate? You take the cost of sales. Now you have to deduct the beginning inventory and add the ending inventory. You can calculate the purchases figures. Likewise, if you take 2014, the cost of sales figure is 189,000. Inventory beginning is 15,500, right? Inventory ending 18,500. Inventory beginning means 2013 ending inventory, right? Then you deduct from the cost of sales the beginning inventory and add back the ending inventory. You can finally arrive at the 192,000 purchases figure. Then 2015 also similarly you can calculate using the same thing. Cost of sales 240, beginning and ending. Here point to remember, beginning of beginning inventory of 2050 will be the ending inventory of 2040, right? You can calculate the purchases similarly for each year 14, 15 and 16. Now you are arriving at a figure called 190,000 for 40, the 30, 14, 245,500 in 2015, and 310,000 in 2016, right? Since we are dealing with two figures from two different income statement and the statement of financial position, we have to take the average figure of the balance sheet one. Now we have calculated the purchases figure, the item from the income statement. For the balance sheet, you have to take the average figure. For you to calculate the average figure, you have to have two balances. That is, in 2014, you need to have in 2013 balance, that is creditors, and in 2014 balance, that is 24,100. Then your average creditor will be 23,400, right? In similarly, you can calculate the average creditor balance for 14, 15 and 16, and using the computation, you will be arriving at figures called in 2015 42 days, 2016 42 days. uh, and how do you interpret? The meaning of this ratio is creditors payment period, meaning how long you take to repay your creditors. How long you take to repay your creditors, right? Now, when you are taking more time to repay creditors, that is good for your company because your creditors are financing your assets, right? But better you take note of it. If this creditors payment period is normally higher due to the inability of the client to repay these creditors, that is a question mark. That is a not good point. As far as this particular client is concerned, if the creditors payment period is higher, not because of your proper management of cash flows, but you don't have cash to repay creditors. If that is the case, then it is not good. Therefore, making payment early to creditors is also not good, but you have to have a particular timeline. But if it is dragging to pay the creditors due to not enough cash in hand or cash balances or whatever it is, then it is a problem for that company. Now, these are very easy to calculate under efficiency ratios, asset turnover ratio. First one is turnover divided by average assets, total assets, right? This is also, you have to take the average balances, turnover divided by average assets. The resulting figure is 1.7, 1.792 for the 2014, 15 and 16 respectively. Uh, we will one by one interpret these at the later stage when it comes to the final summary of the ratio calculation. Now, very easy to calculate this ratio, asset turnover ratio. if you take the final figures 1.71, 1.79, more similar figures, very easy to calculate. You take the turnover, you take the average total assets and divided the turnover by total average assets, and you will end up with the figure. Right. One by one, we will explain at the later stage when it comes to interpretation. This is also a similar ratio, making an efficiency assessment about the efficiency ratios. Non-current assets to equity. You take the non-current assets and you take the shareholder equity. You have a compare and the ratio calculated as number of times. Now, this is very easy to calculate. You need not to take any average figures as both figures are from the statement of financial position. Then very important topic, that is gearing ratios. When it comes to exam and when I correct in your papers, most people tend to find it difficult to calculate these gearing ratios, right? Gearing ratios are the but if you take out of the 6 categories of ratios, um, most of the students are find it difficult to calculate the ratios, the gearing ratios. How do you calculate the gearing ratios? There are two main categories of gearing ratios: gearing ratio 1 and gearing ratio 2. First ratio is, if you take the first gearing ratio, you compare the long-term debt with the equity capital. That is gearing ratio 1. We also say debt to equity ratio. Debt equity ratio. You compare your long-term debt with the equity capital. Your long-term debt with the equity capital. That is the first ratio. You need not to take averages since both items are from the balance sheet or statement of financial position. You take the long-term debts 2014, 15 and 16, and you take the equity capital. Make sure that you take under equity capital, you take normally under equity capital stated capital plus reserves, right? Equity comprised of stated capital plus reserves, right? Now you divided the long-term debt capital by equity capital and you calculate the ratio. Now, when it comes to this particular company, long-term debt capital and equity capital, in 2014, the resulting figure is 0.969, sorry, 0.69 and 15.53, and in 16.42. In both cases, since it is less than 1, it will be low-geared companies, right? Then under gearing ratio 2, we add not only the long-term capital, we take the short-term capital as well as far as debt is concerned. Now, if you go to the calculation in 2014, 15 and 16, long-term debt capital you have already taken. But in case of short-term capital, normally you take the permanent overdraft, right? In the balance sheet, it is clearly given under current liabilities. Under current liabilities, you have two current liabilities, that is trade payables and bank overdraft. You take the bank overdraft. Don't take the trade payables because it is not a debt capital as such. It is a normal part of the business. Therefore, normally you take the overdraft under current liabilities. Those are the capital parts of the current liabilities. Then you add back the total debt capital, and here make sure you take the total capital, right? In this ratio, you can see total debt capital divided by total capital, not by equity capital. In the first ratio, we divided the long-term debt capital by equity capital, right? In the second ratio, we take the total debt capital, not only the long-term, and the other part also in the ratio is different. Instead of total equity capital, we take the total capital. That is total equity capital plus total debt capital. Therefore, you have to add back total debt capital plus equity capital, right? That is, if you take these years, 2014, 15 and 16, 204, 400, 208, 800, 213, 400. Now you can calculate the ratio. Then it will be, the answers will be 0.44, 0.39, 0.39, 35. All are less than 0.5, that is low geared company. All are less than 0.5, that is low geared company, right? Then last category of ratios, that is earning per share, that is investor relations ratio, right? Now, I think you have a better understanding about, because in the previous lecture, we covered the full ratio analysis. What are all the ratios that you are encountered with? Now, this is the computation part only. I repeatedly mentioned the answers for all this. You need not to write down anything. We have given all the answers for this question also, right? To take earning per share, how do you calculate? Net profit after tax divided it by number of shares. Net profit after tax divided it by number of shares. In 2014, 15 and 16, you can easily take the net profit after tax. Net profit after tax. Here also, no need to take different figures. You have to specifically take the net profit after tax, right? I previously also mentioned, some people tend to take, instead of this net profit after tax, the last item in the income statement, that is retained profit for the year. That is incorrect, right? Retained profit for the year, meaning after you distribute dividends from the net profit after tax. But what is required here is net profit after tax. You have to take the net profit after tax, not the retained profit for the year, right? Net profit for the year divided it by number of shares. Net profit after tax is given in the income statement. Easily you can find out 39,400, 44,800, 51,200. The number of ordinary shares, it is given under note number uh, 4. 8 million shares are outstanding, ordinary shares. Therefore, 8 million. Now here, one important point. Now all these figures we calculate, all these figures are given in thousand form in this question. Now, some people don't understand that point, right? You take the net profit after tax in thousand. That is, in thousand means 39,400, meaning 39 million, right? 39.4 million in 2014, right? But when it comes to ordinary shares, they take, as it is given in normal figure, 8 million with 6 zeros, 8 and 6 zeros, they take for the calculation the same figure. That is 8 million as 8 and 6 zeros. But since the upper figure, that is 39,400, it's in thousand, you have to take the number of ordinary shares as also 1,000. That is 8,000, not 8 million as 8 and 6 zeros. Right? If you take 8 and 6 zeros, the computation will be totally incorrect. Right? When I am correcting the papers, I can find out, oh, this EPS, calculation of EPS, at least 5 to 6%, having used this 8 million as 6 zeros instead of 8 million as 3 zeros, right? When the net profit after tax is given in thousands, you have to take the number of ordinary shares also as thousands, right? Otherwise, the final figure will be incorrect, right? Then net profit after tax divided by number of voting shares, then you are end up with earning per share of 4.93 rupees, 5.6 rupees, 6.4 rupees. Right, very easy to calculate, but make sure that you are taking the number of shares correctly as thousands as well. If the net profit after tax are not taking as 1,000, then you no need to take the number of shares as thousands, right? If it is 1,000 in the net profit after tax, you need to take the thousands figures from the ordinary shares as well. Then dividend per share, the same thing. You have to take the total dividend, divided it by number of ordinary shares. Total dividend divided it by number of ordinary shares. Go to the income statement. The dividend declared is given. Right? Dividend declared is given. It's given as 8,000 in 1,000 figures. 16,000, 32,000 and 40,000 in 1,000 figures. Number of ordinary shares already we have taken. For EPS calculation, the same thing can be applied: 8,000, 8,000, 8,000. Therefore, answer will be dividend per share 2 rupees, 4 rupees, and 5 rupees. 2 rupees, 4 rupees, and 5 rupees. Then dividend cover. How do you calculate the dividend cover ratio? Net profit after tax divided by dividend paid. Net profit after tax divided by dividend paid. Meaning you can pay the dividend using net profit after tax. In case of 2014, 2.46 times, right? If you want to pay dividends using the net profit after tax in 2014, you can pay 2.6 times. Right, now we are going to interpret the ratios that we have calculated. Now this is very important part. What is important here is that when it comes to most of the cases, banks are using various softwares to analyze the ratios. Therefore, whether you like or not, the ratio calculations can be automated, and the results can be given in a separate sheet. But once it is calculated, the important point is to analyze and interpret. Analyze and interpret, right? For this, your knowledge is very important as far as the ratios calculation is concerned. Right. Now we will take the first category of ratios, that is profitability. We have calculated 5 ratios, that is gross profit ratio, GP ratio, net profit ratio, that is NP ratio, and ROE, ROC, return on equity, return on capital employed, and interest cover. Right. Now starting from the gross profit ratio, now you can see 46% 2014, 15 42%, almost 43, and 16 41%. More or less similarities there. But here the important point is gross profit ratio cannot be materially varied from 1 year to 1 year. Each year gross profit ratio should be, there should be a similarity. More or less a static figure should be there. The gross profit margin cannot be changed materially from year to year. In this company, it's almost same 46%, 43%, 41%, but there is a reduction, right? Gross profit will depend on 2 items, that is cost of sales and sales, right? Sales means what is your price for the customers when it comes to sales, and cost of sales means what is the amount you spend to produce those items for sales, right? If the GP is reducing, meaning one part is your sale prices are drop or your cost is higher. If the GP is improving, meaning your sale prices may be higher and your cost will be lesser, right? Therefore, the important point here is your GP cannot be varied from one point to 1 year to another year different material, right? Then net profit ratio. there is a reduction in GP, we have to have a comment on this, right? Net profit ratio. How do you interpret? Net profit ratio means your sales to net profit. It can be varied, but it cannot be varied materially. But in a given year, it can be varied due to some exceptional items, right? How do you manage with the balance overhead cost? Now, when it comes to GP, we take only the primary cost, but when it comes to net profit, all the costs, including overheads and other costs, are taken into account. Now, in this company, it is more or less 11%, 10%, 10%, right? No material changes, but there is room for improvements. Then ROE, very good ratio, ROE, 38%, 36, and 38 again. There is a slight decline in 15, but again they have increased to 38%. Very attractive. That is return to equity holders by the company. Now, if equity holders puts 100 rupees, now the company company managed to maintain 38 rupee return, right? Every 100 rupees spent or every 100 rupee invested by the equity holders or the actual shareholders of the company, this company managed to earn a return of 38 rupees, right? That is a good sign. Then return on capital employed, again 41%, 37%, again 41%. That is also a very healthy ratio. To take into account the equity holders and the debt holders, money, the company managed to have a return after deducting all the expenses. They managed to have a return of 41, right? Every 100 rupee, the equity and debt holders spends or the investors. Then interest cover, right? I explained earlier also what is meant by interest cover ratio. That means how many times using your profits a company can pay off the interest. Higher the number of times, better it is. If you take this 2014, 15 and 16, the interest cover number of times are getting reduced. You have to find out what is the reason. Now in 14, it was 5.4. In 16, 3.89. That is not good. The higher the number of times, better it is. In 2014, the company can pay off interest 5 times. But whereas in 2016, it has reduced to 3.8 times. That is not good, right? Therefore, make sure you have to find out what is the reason for that, right? Then summary of working capital and efficiency ratios. We will come to one by one, right? And the expression gearing also we will have a go on the summary, gearing and liquidity ratio, and finally the summary of investor relation ratios, right? Under profitability, these are the important points you have to remember. First, it may be seen that both GP-NP ratios have decreased over the last 3 financial years. This may be attributed to the fact that the cost accelerating at higher pace compared to the sales. I mentioned the GP can be reduced either our sales prices are dropped or our costs have been increased, or the cost have escalating at a higher pace than the sales increase, right? The management should take steps to control cost or increase prices to restore higher GP ratio. Right? When it comes to increase in sale prices, it is not easy. You have a competition and you have a market to compete, right? The price is the very important thing to compete, but what is under your control is the managing the cost. Therefore, the management part is to manage the cost rather than increasing prices will also decrease the demand, right? Then point number 2, it may be noted both ROE and ROCE, although decline in 15, improve in 2016 due to the decline in borrowing. Right? Interest cover decline over the period, but above the accepted level. But we have a point there why it is decreased. You have to maintain the same level, right? Because interest cover is very important for a banker, because whatever the loan given by you will be part and parcel of that interest cover ratio. The liquidity situation was almost near norm in the three financial period. Normally we say the current ratio should be 2:1. That is one current liability, you have to have two current assets. Quick asset ratio, it should be 1:1. That is one current liability, you have to have one quick asset. That is there, and this particular company is concerned, it is there. Then gearing ratios is gearing ratio 1 is below 1 and gearing ratio 2 is below 0.5 in almost all years. Both ratios are declining over the financial years, indicating enhanced capacity for borrowing, right? Enhanced capacity for borrowing, right? Mean this is a low geared company, since both gearing 1 and gearing 2 are well below the uh, accepted level. Both ratios indicate that this company is a low geared company. Low geared company. If it is a low geared company, there is more room for further borrowings, right? Then investor relation ratios, shareholder ratios such as dividend cover and earning per share ratios are improving over the period, which is satisfactory. But I have a concern as far as the dividend per share is concerned. You can see if you go to the dividend per share in 14 to 2 rupees, 15 4 rupees, and 16 5 rupees. Now they have almost not only double, uh, from 2 rupees to 5 rupees. They have increased number of dividend per share. They have increased by 2 rupees to 5 rupees in these 3 years. Therefore, that is not a good sign, because uh, dividends, you can once you pay off the dividends, meaning your cash will be out of the company, right? The But for the future expansion, future investment, the company will have to retain something, right? You have to pay dividend for the shareholders, but you make sure that you have to retain something for the future as well, right? Therefore, dividend per share is doubling, not only doubling, more than double the when it comes to 2014 compared with the 2016 figures. Right. Now this was also very important. In most of the cases, some people uh, forget to do the risk analysis also. Right? When you are writing the answers, after you calculate, after you interpret all the ratios, make sure you also do a risk analysis like this. Taking into account individual categories, you have to clearly indicate what is the risk position. Right. Now we have computed all the ratios. Now we have categorized risk categories into 4 categories. That is under profitability. Profitability risk is risk measurement. Medium. Why we said medium? There is some concern on gross profit ratio being reduced and net profit ratio not much that attractive, but it is not, risk is not high, but it's medium. Liquidity also up to the standard, but not higher liquidity position, but up to the standard. That's why we say medium risk. Then gearing, we can clearly say it is low risk, because in all 3 years, and the two gearing ratios, gearing ratio 1 and 2, are low geared position. Therefore, there is more room for lending for this company. Then shareholder benefits, very satisfactory. from the shareholder point of view, that is satisfactory, but I have a concern in dividend per share. Because of the medium profitability, liquidity risk, and the decline interest cover, one have to exercise caution in considering further facilities, right? We have a concern that is uh, interest cover is lower from the 14 to 16. You have to consider that when you give away further facilities to this company. Because of high demand for the products of the company, one could expect profitability to increase. In such circumstances, fully secured further facilities could be favorably considered. Another thing you have to take into account, that is this company is a low geared company, therefore there's a possibility of lending to this company. Then how you structure, right? Now we have clearly answered the first part of the question, that is calculation of ratios, then interpretation of ratios, and uh, risk assessment, right? Now you can, if you have correctly answered, you got 20 marks. For the calculation of ratios and interpretation, we have allocated 15 marks, and for the risk analysis, there are another 5 marks on top of it. Altogether 20 marks. Then under second question, they ask, in the event of considering additional facilities, describe the type of facilities you may consider. Right. This is also important. You can have different options, right? Option 1, option 2, option 3. As credit officers, you can propose a new offer letter comprised of different categories of loans, or you can restructure the current facilities to facilitate the requirement of the client, right? Now, what are the options available? Now, we can see in the example, the client have exceeded the overdraft limit, which is 10 million approved limit. Currently, they have exceeded another 6 million. Now, current outstanding is 16 million. But if you take the term loan, 80 million approved. Now they have repaid 22 billion, and current outstanding 58 million. Now we have a leeway of 22 million there. And the other thing is, this is 60% exposure again the this premises of the land and building of the company. All valuation is 150 million, and they have got a new valuation of 170 million. Right. With this background, you can propose new facilities, and the client is in need of a requirement of 15 million. That is for 5 million as working capital and 10 million for the machinery, additional machinery. That is all together 15 million requirement is there. With this scenario and the ratio analysis, you thought we can consider additional facilities for this client with the background of the ratio analysis and the risk analysis we made and the interpretation. Now you can propose additional facilities. Right. If you take the first option, I have proposed the facilities, that is existing limit is term loan 80 million, present outstanding 58 million, overdraft 10 million, present outstanding 16 million, and we have a total exposure of 90 million, right? Out of that 90 million, we can give away for the term loan 59 million, right? To accommodate the present outstanding, then you can reduce the term loan limit by 21 million, right? By reducing the 80 million limit to 21 million, by 21 million, the current limit will be 59 million. That is the current outstanding of the term loan. Then to accommodate the exceeded present overdraft limit, you have to increase the overdraft limit from 10 million to the proposed limit of 16 million. And now the total exposure is 90 million, 59 plus 16. Now you have consumed out of the 90 million, 59 plus 16, that is 75 million you have consumed. Now you are left with 15 million. For that, out of that 15 million, you can propose a new limit of new loan of 2 years against the same mortgage bond for 2 years. By allocating 15 million for this company, the working capital requirement of 5 million and the new machinery requirement of 10 million can be accommodated. That is option 1, without considering any more securities, and within the current exposure limit, we can give away this 15 million. What is the proposal? Term loan, you reducing the facility limit to from 80 million to 59 million. Overdraft, you are increasing the facility limit of 10 million to 16 million, and you are proposing new loan of 15 million. In altogether 90 million. Right. This is an explanation of that. Consider option 1. Consider the existing approved limit of term loan 80 million. Since the balance in the loan is less than the approved limit by 18 million, reduce the limit to 59 million. Consider the new loan of 15 million repayable in 2 years for the current requirement. Increase the OD limit by limit to 16 million and ensure that company operates below the limit. That is the first option available to us. We have to write only one option in the exam, right? No need to give away 2 or 3 options. You have to correctly write down one option in the exam paper. Then the option 2. Under option 2, we propose a new term loan. We propose a new term loan of 80 million, right? We propose a 80 million new term loan for 3 years. And balance 10 million, we allocate a leasing facility for the machinery. Now we have finished with the 90 million. What do you do for this 80 million? Out of this 80 million, you recover the already outstanding amounts of term loan 58 million and 16 million overdraft, right? By giving a new loan of 80 million, you recover term loan 58 million and overdraft 16 million. And for that, you have to spend 75 million and you are left with 5 million. That 5 million can be used for working capital requirement, right? And you are also proposing a new lease facilities for the 2 machinery, 10 million, and you can accommodate the current requirement within the current exposure of 90 million, right? We will have an explanation also that the company has an approved limit of 90 million. Consider new term loan facility of for 80 million, amount repayable in 3 or 4 years. Recover the term loan and the overdraft fully. The balance could be utilized for the working capital requirement, right? Out of the 80 million, 75 million you have to spend to recover, or you have to absorb to recover the current outstanding of term loan and overdraft, and you are left with 5 million for working capital and a leasing facility to be used to purchase the machinery by mortgaging the assets, right? Using the 10 million left in the current exposure 90 million. Right. That is the option number 2. I have a third option also. Now this time we are using the new valuation report that they have taken, right? Under new valuation report, they say 170 million, right? All valuation report is 150 million. Now they have increased the valuation by 20 million, right? We have an exposure limit of 60%. For that additional 20 million increase in the valuation report, 60% into that means 12 million we can additionally grant if we consider the new valuation report, right? That meaning 12 million meaning our total exposure will be from 90 million will be increased to 102 million, How do you arrive at that 102 million? In the new valuation report, you have a new value increase of 20 million, 150 to 170. That value increase of 20 million into 60% exposure mean 20 million into 60% means 12 million, right? That is the 12 million increase in the proposed limit, right? Therefore, your current exposure is 90 million, 12 million increase, then altogether 102 million, right? Now you can use this 102 million to propose new facilities for the client. Now, under third option, I am proposing a new term loan of 90 million, right? New term loan of 90 million to repay the current outstanding of 58 million term loan and 16 million overdraft. And by repaying that term loan and overdraft using this 90 million loan, you are left with another 15 million, million. That 15 million you can easily use to purchase the machinery and for the working capital use. And additionally, since we have another 12 million left with in the new exposure, we can additionally propose a packing credit facility if it is when it is used can be used another 10 million and a overdraft facility of 2 million to be used when it is needed, right? The current exposure is 102 million. You can use that current exposure. I think you are very clear about the three options available using these customers facilities. Option 3, the new value of the property is 170 million. Mortgage value at 60% will be 102 million. Approve a new term loan of 90 million. Recover the existing loan outstanding of 50 million and overdraft of 16 million. By recovering those two, you have to absorb 75 million out of the 90 million and you are left with 15 million. 15 million you can easily use for the working capital and the machinery. Out of the balance, allow the company to purchase the machinery of 10 million and working capital of 5 million. The balance of the limit, offer a packing credit facility 10 million and overdraft facility of 2 million when it is needed, right? Right. That will be the answer for the question number 2. And then we'll go to the question number 3. Suggest your recommendation to the management of MS Fashion Apparel Private Limited to enhance financial position without requesting additional facilities from the bank. That is a different question, right? In this question, the examiner asks for you to be part and parcel of the management of this company and without considering or without asking further facilities from the bank, you have to give solutions to resolve the current requirements. What is the current requirement? That is 10 million for machinery and 5 million for this working capital. Then you have to propose those proposals from the management side of the company, not from the bank side, because the it specifically says you need not to go to the bank, and from the management side you have to propose something to resolve these issues. That is, we need 15 million from the in-house, not from the outside, right? Instead of asking loans from the banks, what are the options available for this company to resolve this 15 million issue or requirement, right? The first we can propose. Now, if you take the first point, the company was paying higher dividends in the financial year 15 and 16. The company may pay dividends similar to 2006-13, by which about 40 million can be saved, which could be used to reduce credit facilities as well. What is that point? Now, the proposal is to reduce the dividend per share similar to 2014, right? Similar to 2014. In 2014, dividend per share is 2 rupees. Now in 16, it is 5 rupees, right? We have 8 million shares. 8 million shares. In 2015, if you pay a dividend per share of 2 rupees, right, which is similar to 2014, you can save, this company could have been saved 16 million. 16 million, right? 16 million. If you pay the same dividend per share in 2016, that is 2 rupees, now they have paid 5 rupees, meaning you can, every share you can save 3 rupees each. For 8 million shares, you can save 24 million. That is 8 million into 3 rupees. 24 million, right? In conclusion, by paying a dividend per share of 2 rupees equivalent to 2014, in 15 and 16, 15 you can save 16 million, that is 2 rupees into 8 million. In 16 you can save 24 million, that is 3 rupees into 8 million. Altogether you can save, this company would have been saved 40 million if they have paid a dividend of 2 rupees, which is similar to 2014 in 15 and 16. If they managed to do so, they could have been saved 40 million. By having 40 million, they can not only accommodate this requirement, but they could also repay some of the current facilities, right? That is strategy number one. But now we cannot, even though we can propose this, but we cannot implement this because we have already paid the dividend, right? Therefore, at least in 2017, this company may have to have a strategy to have a lower dividend per share, right? Or which is equivalent to 2016, right? Then the second proposal, the company could consider for a debenture issue. The company could consider for a debenture issue of say 50 million. 50 million. Right? Instead of going for bank loan, since this company is a very good company, having very good reputation in the market, they could ask for a dividend issue. But in case of this dividend issue, even though we are proposing that, this company will have to compare uh, the bank offering rate and the dividend rate, debenture rate that they are going to issue. Now, if the debentures are issuing at a higher rate than the bank loan, there is no use of having debenture issue, right? And companies having a good dividend policy and a good brand name, they can have a success, but make sure that it will take some considerable time. When you are organizing a debenture issue, administratively, it will be more difficult than taking a loan from a bank, right? And you have to print the prospectus of the companies, you have to have some advertising, right? Therefore, taking into account all these scenarios and the interest rate, if the interest rate of the debenture is higher than the bank loan, then there is no bank borrowing, there is no use of having a debenture issue. Right. Then the third point we are proposing, the company debtor collection period is almost a month. Now we have given debtors a 1 month period to repay their debts. We may have to offer discount for early payments, right? We can offer debtors to discount for early payments by having that. Now, if you take this company's debtors in 2016, their debtor balance is 42 million, 42 million, right? If we can realize 50% of those debtors, then we can have 21 million. Using that 21 million, we can fulfill our requirement, that is 15 million requirement, right? But you have to encourage your debtors, at least you have to give some discount for the early payments. That is another proposal. Then the proposal number 4, the net asset value per share of the company is 139.8. Sorry, net asset value per share is 17.42. How do you calculate? You have to take the equity, total equity value in 2016, that is 139,400, divided it by 8 million shares. That is the price for share in the books of accounts, right? Net asset value per share, right? Book value of a share, that is 17.2. How do you calculate? You have to take the total equity divided it by ordinary shares, number of ordinary shares. Then directors may consider issue 6 million shares at 16 rupees, right? 6 million shares at 16 rupees. How do you arrive at this 16 rupee per share? Since you have a net asset value of 17 rupees, you can, if you can issue the shares at a lower price than the book value, then there will be demand for the share. That is why we select the 16 rupee per share. And 6 million shares, 16 rupees, you can take 96 million. Then the proceeds of the issue may be used to meet the present requirement, not only meet the present requirement, and to settle all the facilities as well. This may reduce the finance expenses by the company must, but make sure that you must enhance the profit at least by 12 million. Why? At least by 12 million. You have additional 6 million shares now. If we pay the same dividend per share, that is 2 rupee per share, that is 12 million, right? Additional dividend of 2 rupees. Now, if you are going to pay 5 rupee per share, then your profit needs to be at least increased by 5 rupee into 6 million, that is 30 million, right? Here I am referring to the dividend per share given in 2014, that is 2 rupee per share. If it is so, for the additional 6 rupee, you have to have additional profit of 12 million. But if you are giving 5 rupee per share dividend, then at least 30 million increase in profit. It must also be noted that the directors must be willing to for this new share issue. Sometimes your directors be embarrassed, or if it is a private company, this new share issue should be borne by the directors, right? If it is a public company, then you can go for a marketing campaign and advertise on the share issues. But if it is a public company, the current directors should be in an agreement for the new share issue, right? Sometimes some directors disagree, right? If they don't have money, they may disagree with the decision, right? uh, Next point is, because this company is having a higher demand for these products, and there can be confirm orders, the particular confirm orders, this company may ask for some advances from the foreign party or a local party, right? Since these companies' products have a higher demand, the company can ask for advance payment for the orders that they have confirmed their clients, right? By having that advances, they can easily collect this 15 million and use that 15 million as working capital and machinery, investment in machinery. That is another option, right? Now I have proposed five proposal. That is, one is even though we are proposing dividend thing, that is already been gone, but it's just a proposal, not a solution for this requirement. But the second proposal is to having a debenture issue for the company shareholders or the other people, and encouraging debtors to have a early payment by having a discount proposal. Then have a fresh share issue, considering the net book value of the share. And finally, with the confirmed orders, they may ask some clients to send advances for the company. Right. Now I have given another question paper, that is 2016 May 1. I may also spend another hour on this answer also. This question also similarity is there, but if you read out the question, you are the credit officer of Alien Bank PLC, Mrs. MS Alpha Business Solution, and they have given the requirements, and it means the satisfactory current accounts with the average balance of LKR 100 million, sorry, 10 million. At present, they enjoy following facilities. Approved limit is 80 million, outstanding 62 million, overdraft 20 million, outstanding 26 million. Here also you can see they have exceeded the overdraft limit by 6 million. And Alpha Business Solution has plans to expand its business. Recently, the company had signed 3 contracts, 2 of which are from overseas clients, to deliver software solution within the next 6 months. In order to meet this requirement, the company has to purchase 6 computers and recruit experienced staffs. The company requires additional facility of 10 million to meet the working capital requirement. Right. The Chief Financial Officer, MS Alpha Business Solution, had approached your bank for additional facilities to meet their requirements. You, as the credit officer, had requested for the income statement and financial position statement of the company for the financial years 31/3/2014, 31/3/2015, and 31/3/2016. The summarized audited results for the financial year 31/3/2015, 31/3/2015, and unaudited financial results for the year ending 31/3/2016 are given below. Right. Now, income statement and the statement of financial positions are given. Additional notes are also given. Note under current assets, working capital progress is the cost of the work performed, not invoice. That is one point. That is not the invoice value. That is cost under working capital. Working capital means work in progress means not completed inventories, right? And you are also given the following additional information. You may assume that the trade receivable and trade payable balances reflect in the balance sheet are average balances. Right. Here, the important point is the examiner clearly indicate you may assume that trade receivable and trade payable balances reflected in the balance sheet are average balances. Right. You may use year-end figures in the financial position statement for computers. Right. Now, examiner clearly stated that when it comes to average balances, you have to use these year-end balances. No need to take the average balances. You have to take directly, instead of taking average balances, you have to take the year-end balances. Therefore, when it comes to calculation of ratios using the average balances will not materialize. In that case, you have to use the year-end balances. Now, I am not putting a lot of effort on calculation these ratios because I have given the answer sheet and the ratio, because I will directly go to the interpretation part. Right. Now, under profitability, in this question, gross profit ratio, you have to calculate the net profit ratio, return on equity, and return on capital employed. Now, every ratio you can see, no need to take the average balances, since the examiner allowed you to take the year-end figures as the average balance, right? Now, normally in the previous question under return on equity ratio calculation, we used to take the average equity. Now, in this question, for you to calculate the average balances, there should be, the examiner should give the some other figures for you to calculate average balances, since it is not given. And also, examiner clearly indicates that you have to take the year-end figures as average balances. You have to take the year-end figures instead of average balances. Right. Similar ratios we have calculated in this question paper also, and under profitability up to interest cover, under liquidity current ratio and the quick asset ratio, under gearing ratio 1 and gearing ratio 2, earning per share under investor relation ratios, dividend per share under the investor relation ratio, earnings yield, and dividend yields. Now, since we have not discussed the earnings yields and dividend yields, I will discuss here in this question. Now, how do you calculate the earnings yield? Earning yields is earning per share divided it by market value per share into 100. Earning per share divided it by market value per share into 100. Right. Now, you have to take the earning per share, which calculated earlier ratio, the sheet 4.83, 9.17, and 9.33. And earnings yield, earning per share divided by market value per share, you can see earning yields is 26%, 47%, and 38%. Right. Then dividend yield, the same way, dividend per share divided by market value per share into 100. Similarly, dividend per share we have calculated already, and market price per share, same market price you can apply, and the final resulting figure is 16%, 23%, and 25%. Right. Now we'll directly go to the trend analysis. If you take the profitability, now we go to the profitability summary. Now, under profitability, you can see gross profit ratio. I previously mentioned it should be a static ratio. Gross profit cannot be varied from one year to another year dramatically. Now here 34%, 37%, and 36%. Almost in a similar range, 35% to 37%. Net profit ratio very low, 6.4, 8.21, and 6.2 again, right? But comparatively very low figures. ROE, return on equity, 26%, 40%, and 35%. And ROC 39%, 44%, and 52%. Very attractive increase in trend. And interest cover 3 times, 3.39 times, and 2.71 times. Right. There is a reduction, but it's almost 3 times. Right. Now we will interpret the profitability ratios. Right. It may be seen that GP, net profit ratio, ROE, and interest cover ratios increase in 2015 but decline in 2016. It may be attributed to the fact that the expenses increased by 1.3% compared to the increase in gross profit by 1.25% over the previous year. However, ROCE recorded an increase over the 3 years in the period. You have to write these interpretation, right? Now, the important thing is ratio wise. Now, this is a profitability. As a summary, I have given the interpretation, but if it is better, you can in ratio wise, for example, say gross profit ratio, you have to have the interpretation, or net profit ratio, you have to have the interpretation. Likewise, ratio wise, you have to have the interpretation whether it is good or bad, right? Now, in this scenario, profitability, this company 2015 there is an increase, but in 2016 again it is decline. And one point, if you properly read out the question, in 2016 they have only draft accounts, not the audited accounts. Therefore, before giving any loans granted for this client, you may have to ask the audited financial statement for 2016 as well. If not, otherwise, whatever these draft figures cannot be accepted very reliably. Therefore, you need to, that is a one point you have to point out in your answer it also when you're writing the answer in this type of questions. If the audited figures are not given, you have to wait until the audited figures are given by this client before releasing any credit facility to the client. Therefore, under profitability, you have a question, but net profit ratio, you have to clearly mention that is very low. Net profit ratio is very low compared to normal industry accepted standard. That we have a question mark in there under net profit ratio. Then, second category of ratio is the liquidity and gearing. Right? First, we take the liquidity. Current ratio, there is a norm of 2:1. It is maintained by this client in 2016 also almost 2:1, and quick asset ratio also 1:1. That is also properly maintained by this client. Therefore, you can clearly mention under liquidity, this client has managed to maintain the liquidity properly. With the accepted level of the industry practices, that is under current ratio 2:1 and quick asset ratio 1:1. Therefore, as far as liquidity is concerned, this company is in a low risk position. This company is in a low risk position because they are having this good liquidity requirement, right? Under liquidity, the company liquidity situation was almost near norms in the 3 financial years. Therefore, no issue in the liquidity. Then when it's come to gearing ratio 1, if you can remember what is gearing ratio 1? Gearing ratio 1 is you compare your long-term debts with the equity capital. Long-term debt with the equity capital, right? If it is below 1, meaning your long-term debt, under 2014, the answer is 0.28. That means your equity is 1, right? Not equity is 1, your equity is 0.72, but whereas your long-term debt is 0.28, right? If it is more than 1, it is high gear. In the second ratio, instead of taking the equity capital, you take the total capital. But here, under debt capital, not only the long-term debt capital, you tend to take the short-term debt capital also. But here, the short-term debt capital, you have to make sure that you take the short-term loans and the overdrafts only, not the trade creditors, right? But under gearing ratio 2, it should be 0.5 less than 0.5, right? In 3 years, the 0.28, 0.41 and 0.36. All 3 years below the 0.5 level, that is also low geared company. That is also low geared company, right? Now, in conclusion, gearing ratio 1 less than 1, low geared in every 3 years, and gearing ratio 2 also less than 0.5 in every 3-year cases, that is also low geared. Therefore, in conclusion, we can say this company is a low geared company, right? Low geared means this company more relied on equity capital rather than debt capital, meaning the company is in a good position for taking another borrowings. Then the bank's point of view, giving facilities to low geared companies is very much attractive, very much better, right? Because if you have a high given facility to high geared company, you have almost exposed to loans already. Therefore, by having more facilities again, your exposure to the debt capital is higher than a low geared company. Therefore, as far as the lending people is concerned, this particular company is concerned, this company is having a higher chance of getting more facilities since this is a low geared company, right? And the gearing ratio 1 is below 1 and gearing ratio 2 is below 0.5. Both ratios decline over the financial year 2015. In conclusion, that is low geared company, right? Then under investor relation, earning per share 4.83 to 9.33, very attractive, higher earning per share. DPS also, higher dividend per share, almost double the 2016 amount. But I have issued the same issue, but I discussed with the earlier sum, that is paying higher dividend, almost double, 3 rupee per share to 6 rupee per share. That is double the dividend payment, meaning you are taking off your cash from the company to the outside, right? If you can manage now, since this company is having, if you go to the balance sheet, this company is having 6 million shares, meaning if you can, if you could have maintained the same dividend per share similar to 2014 in 2016, that is 3 rupee per share, this company could have been saved 18 million rupees, right? 18 million rupees within the company by paying dividend, higher dividend per share, meaning uh, you are taking off your cash to the another out of the company, right? Then dividend yields very much attractive. There is a increase in 15, but dip in 2016, that is not that much material. But dividend yield with the higher dividend per share, it is getting increase every year. Earnings is also very much attractive. Under investor relations, shareholder ratios such as earning per share and dividend per share are improving over the period, which is satisfactory. Although both earnings yield and dividend yields improve in 2015, both decline in financial year 2016 due to the increase in market price as at 31st 2016. In conclusion, if you take the risk analysis and conclusion, Profitability ratios, you have a medium risk, because I mentioned this particular company, their net profit ratio is very low, but gross profit ratio is very good, but net profit ratio is very low. Therefore, you have a medium risk, not high risk, but medium risk is there. Liquidity risk is very low, because they have maintained the current ratio and the quick asset ratio up to the norms accepted level. Then gearing ratio is also very low, low geared company. Gearing ratio is very low, low geared company. Uh, uh, and but if you take the shareholder benefits and shareholder relation ratios, it is a very satisfactory level, since you have higher dividend per share and higher earning per share throughout the 3 years of the period. Uh, Therefore, further facilities can be considered favorably. However, we must obtain the audited financial statement. Very good point. That is, auditor obtain before disbursing any facilities to the client. We must obtain the audited financial statement from the client before releasing funds to the approved facility. Since we have a low geared company and a low liquid and satisfactory level of profitability is there. Therefore, we can consider further facilities. Now, we will go to the second part of the answer, that is structuring the facilities. Now, if you take the structuring of the facility, total exposure, current exposure is 100 million. That is 80 million term loan and 20 million overdraft. But if you take the total, currently they have present outstanding of 62 million of the term loan. That is 18 million less than the original proposed limit, but they have exceeded the overdraft facility from 20 million to 26 million. Now the proposal is to propose a new term loan of 80 million, new term loan of 80 million, and the current proposed limit of overdraft facility will remain as same. Then we are having 100 million exposure, but with the 80 million new term loan, you can repay the 62 million outstanding of this current outstanding of the term loan. Then you are left with 18 million. With the 18 million, uh, reduce the overdraft by 8 million and 10 million for the requirement, right? Now, I will repeat it again. We are proposing a new new loan facility of 80 million for 3 years for the existing mortgage bond. And out of this 80 million, and we can repay 8 million of 62 million of current outstanding of the term loan. Then we are left with the 18 million. Out of that 18 million, 10 million of for the current requirement, and balance 8 million you can use to repay the overdraft limit. And by repaying 8 million from 26 million outstanding to repaying 8 million, it will come to the 18 million, and current proposed limit is 20 million of the overdraft. Therefore, we are within the 100 million exposure, right? In the it will have some explanation also. Consider the existing approved limit of the term loan, rupees 80 million. Since the balance in the loan is less than the approved limit of 18 million, consider new loan of rupees 80 million repayable in 3 or 4 years, recover existing outstanding of 62 million, allow the company to utilize 10 million to purchase the computers and reduce the overdraft by 8 million and bring it below the limit, right? Limit is 20 million. If you repay 8 million for the current outstanding of 26 million, the overdraft current outstanding will be reduced to 18 million, which is below the 20 million approved limit. Then consider new loan facility of 62 million to meet the current outstanding, increase the overdraft limit by 18 million, increasing the original approved limit. The company can lease computer and meet the rental outstanding OD and use this facility to meet the requirement. Right. This is the second proposal. Right. If you go through this second proposal, now we can reduce the existing limit of 80 million term loan to the present outstanding, that is 62 million. Right. You have originally given the exposure 80 million. Now you are reducing it to, proposed limit is to reduce to 62 million, which is the current outstanding amount. Then out of the 100 million, you are left with 38 million facility, right? Exceeded the overdraft limit from 20 million to 38 million, right? Now you have an overdraft limit of 38 million, which you can use. Therefore, using the overdraft limit, 18 million, additional 18 million. Now you have currently used 26 million. No? 38 million is the additional limit. Now you are only left with 12 million. Using that 12 million excess, you can meet up with the lease rental and the working capital requirement. Right? I will repeat it again. We have 100 million exposure limit. Out of that 100 million, we use 62 million for the term loan of the existing loan by reducing from 80 million to 62 million. Now it is settled, right? Now with the present outstanding of 62 million, we reduce the term loan limit to 62 million, right? Now it is okay. Then out of the 100 million, we use 62 million, we are left with 38 million. The total 38 million, we are proposing an extension or enhance the overdraft limit by from the original 20 million to 38 million, right? By enhancing it to overdraft limit to 38 million, current outstanding is 26 million. Now current is left with, the client is left with additional 12 million in the overdraft facility. That 12 million can be used to the requirement, current requirement, that is lease rental and working capital requirement, right? That is the second option. Since two of the contracts signed are from overseas, now if you go to the requirements, we have calculated the ratios and we did the risk analysis. Point number 3, in the event of considering additional facilities, describe the type of facilities you may consider and recommend. And this is another facilities to be offered. That is, since two of the contracts signed are from overseas clients, we could request the supplier to open letters of credits to your bank and consider granting facilities against them, right? Now we have two foreign parties. Now they have signed the contracts, right? The directors may consider to expand the business considering the overseas opportunity, considering the company going for 1 million shares, right? That is another option. First option is to using the sign contracts of with overseas client. You can have LC facilities and ask using that facilities, you can granting facilities against them. And the second option to have a share issue, right? Considering a share issue of 1 million shares for 20 million, you can raise 20 million shares worth of money, and you can reduce the OD requirement and a present requirement you can easily set up. With the 20 million without structuring facilities, with the 20 million of this new issue of shares, with the amount of money you gain, you can settle the additional exceeds of OD facility of 6 million, and out of that balance 14 million, you can taken care of the current requirement of the working capital and the lease rental of the machineries. And since this is the last session of this credit management course, as far as this first uh, sum is concerned, I will like to pay your attention on few mistakes done by the students in the exams. Now I will try to, even though there is no slide on these uh, mistakes, I will recall with some notifications, because I want to emphasize these things, because in most of the cases uh, I have taken some pictures of these examination papers. Therefore, when you are writing your answers, make sure that you won't be doing these things when you are writing your answers. Right. One by one, I will explain. First thing is, now when you're calculating the current ratios, now if it is better if I can show you the uh, photo as well, but here it's very difficult due to this current situation. Now common mistakes are uh, some people try to attempt this question. This question carries almost 30 marks, 28 marks out of your question paper. If a question carries 28 marks, 30 marks, don't try to do this question at the last minute, right? If you are going to do that in the last minute, then it will be very difficult for you to get the marks, right? I think this is the very easiest question for you to get 28 marks out of the other questions, which is more or less the theoretical questions. But as far as the exam is concerned, if you don't do this question, you will get failed. Therefore, it is very important for you to attempt these questions with sufficient time. If you are attending this question as the last question, make sure you are almost left with 1 hour to complete these questions. If not, otherwise, it will be very difficult for you to complete this question. And some people, I saw when I am correcting the answer sheet, some people, they just merely write down the ratios, names only. They hardly attempt these questions at all, right? But few mistake, if I recall another mistake, that is uh, I already explained in the when I do the previous sum. Uh, when it's come to calculation of EPS, DPS, right? Now, in the question paper, all the figures are given in thousands. Therefore, if you take in terms of thousands, the net profit is 24,200, means 24 million, right? But in the additional notes, the ordinary shares number is given as normal, uh, as a normal number. That is, for example, say 8 million. 8 million is given as normal number, that is 8 and 6 zeros. Now, when it comes to calculation of EPS, people take net profit after tax as, now I will go to an example. Now, if you go to this EPS calculation, at this, now here, net profit after tax in 2014, 29,000. That is 29 million. But this 6 million, it is given as 6 and 6 zeros in the question paper itself, not in thousands. But some people, you take 29,000 here as 1,000 figures, but number of shares, instead of 6,000, you put 6 million, right? Then your ratio, instead of 4.83, it will be 0.00483, which is not correct, right? Therefore, that is the most uh, frequent mistakes I have found. I mean, correcting papers, that is the most frequent mistake done by the students. And the other thing is, when it comes to gearing ratios, people tend to take first gearing ratio 1. You have to make sure that is uh, long-term debt divided by equity capital only. When it comes to gearing ratio 2, the scenario different. Long-term debts plus short-term debts divided by total capital, not only the equity capital, right? Therefore, in order to understand properly, you have to have proper understanding about these ratios clearly. Not otherwise, it will be very difficult for you to get all 28 marks. There are people, there are a number of people out of, normally when it comes to a particular batch, there are about 200 people setting for the exam. Out of these 200 people, at least 20-30 people getting uh, uh, all the marks out of 28 marks have been taken, right? But there are few people, like 10 to 15 people, they are not hardly attempt this question at all. But make sure, and the other thing is, to take these summaries, once you done all these things, this is very important, risk analysis and conclusion. You have to express your opinion on each category, that is profitability, liquidity, gearing, shareholder benefit. Every time you have to say risk analysis, whether it is low risk, medium risk, high risk, or low risk, right? You have to clearly mention that. If not, otherwise the allocated marks won't be given to you, right? This particular risk analysis part, we normally allocate about 4 to 5 marks. If you don't do this part, the risk analysis part, and the overall risk conclusion of the client, right? You can also speak about the individual categories of risk. Not only that, overall risk, if you take into account all these categories, what will happen to the overall risk, right? That is also very important, right? Therefore, uh, I go to the beginning of the questions. If you want to take the net profit after tax, not now, in the question paper, if you go to the income statement, the last, not the last item, net profit after tax, right? You go to the income statement, the last item is the retained profit for the year, not the net profit after tax. Last item is the net profit, retained profit for the year, right? But if you take some students, they take the last item, assuming that that is net profit after tax, right? Those are, I call negligence, not mistakes, negligence, right? If you want net profit after tax, clearly you have to take the net profit after tax, not the retained profit for the year, right? If you take the last item of the income statement, it is not the net profit after tax. It is retained profit for the year, not the net profit after tax, right? I think if you have any questions regarding the this calculation and regarding this first question, I have given my mobile number to the Menaka at IBSL. If you want, get it from him, and you can ask any question from the mobile number. And further, we will have a question and answer session on this. If you want to uh, have questions, you can ask question in a further session. The IBSL will be accommodating that aspect also. But for the time being, if you have any doubts in this area, you can contact Menaka at IBSL and ask for my mobile number and give a call to me, and I will have a clarification on that. And other thing is make sure that you allocate additional time for this question. And if you all the materials I have given, and before conclusion, for since this is for Kandy students, uh, uh, my name is Asanka Lienege, and you can refer my name when you are referring to these particular questions if you are a Kandy student, because I didn't visit to Kandy area this time, and a different lecturer did the first 3 sessions, and using this online technology we are conducting the final sessions. And still, if you have any question, you can refer Menaka at IBSL, and he will definitely help you to resolve anything. Right. Thank you.